Think about your last trip to the grocery store. You walk down the aisles, grabbing cereal, maybe some yogurt, a baking mix, or even pet food.
Right.
What if I told you that so many of those brands, from Cheerios to Blue Buffalo, they all belong to just one huge global company?
Yeah, it's pretty amazing when you stop and think about it.
So today, we're doing a deep dive into that company, General Mills.
Exactly. And for this, we're going straight to the horse's mouth, so to speak. We're using excerpts from their official 2024 annual report, the Form 10K.
Which is like the ultimate guide to what a company is really doing, right? Finances, strategy, the whole nine yards.
It really is. It lays out everything, their performance, their plans, all the inner workings.
So our mission today, basically to give you a shortcut to understanding this food giant, we'll look at how they did recently, what their strategies are, and maybe some of the surprising stuff behind the products you see every day.
The goal is you walk away feeling, genuinely clued in, without having to wade through hundreds of pages of dense reporting yourself.
Okay, let's dig in then.
So General Mills, it's way more than just cereal. I mean, their history goes back over 150 years.
Wow, 150 years.
Yeah. And they use that phrase, making food the world loves. It sounds like marketing speak, but when you look at their reach, over 100 brands, 100 countries, 6 continents, it's kind of true.
It's this massive global pantry, really.
It is. And that global scale isn't just about size, is it? It's strategy.
Right. You mentioned joint ventures like Cereal Partners Worldwide with Nestle.
Exactly. CPW, that handles their ready-to-eat cereal basically everywhere except North America. And then there's Haagen-Dazs Japan, HTJ, that's another joint venture, focused just on that super premium ice cream market in Japan.
So what does that tell us? Why not just go it alone everywhere?
Well, it suggests they're smart about it. Partnering with Nestle gives them instant scale and market know-how internationally for cereal. It avoids having to build absolutely everything from the ground up.
Okay, saves time, saves money. Makes sense.
And with Haagen-Dazs in Japan, it lets them really dominate a specific high-value niche market with a local focus. It's about finding the best way, maybe not always the direct way, to grow.
Okay, so to really get a handle on this giant, we need to understand how it's actually, put together, how they structure things.
Yeah, the operating segments. They've divided the business into 4 main chunks.
4 core segments. What are they?
First, there's North America Retail. That's the one most of us probably interact with daily. Think Cheerios, Betty Crocker, Pillsbury stuff you buy at the grocery store.
Got it. The familiar stuff.
Then International. This covers everything outside North America Retail. So Haagen-Dazs globally, Old El Paso, local snack brands, things like that.
Okay. And number 3?
That's Pet. This is dominated by Blue Buffalo, their natural pet food brand. It's been a really big growth engine for them.
Right. I remember when they bought Blue Buffalo. That was a big deal.
Huge.
Yeah.
And finally, North America Food Service. This is the B2B side, supplying products to restaurants, schools, bakeries, convenience stores, you name it.
So a really diverse operation. Retail, international, pets, and food service.
Super diverse. And their customer base mirrors that. Grocery stores, obviously, but also mass merchandisers, e-commerce sites, food service distributors, restaurants, even pet specialty stores.
That range from, big box stores to online clicks must be complex to manage.
Oh, absolutely.
And the report mentions one customer specifically, Walmart. They account for 22% of total sales and 30% of North America retail sales.
Yeah, that's a significant chunk.
Isn't that risky? Relying so much on one single customer, even if it is Walmart.
It's definitely that double-edged sword we talked about. On the one hand, incredible volume, efficiency, and distribution. On the other, Walmart gets a lot of negotiating power.
So they're constantly doing a balancing act there.
Always. Trying to grow other channels while keeping that massive relationship healthy. It's classic big retail dynamics.
And even for a giant like this, seasonality plays a role, right? It's not all just steady demand year-round.
A little bit, yeah. The report mentions things like Progresso soups selling more in the fall and winter, naturally.
Makes sense. Soup season.
And Haagen-Dazs ice cream obviously peaks in the summer. But overall, they say demand is pretty evenly balanced across the whole year when you look at the big picture.
Okay, so that's the structure, the brands, the customers. How did all this actually translate into financial performance in fiscal 2024? Let's get into the numbers.
Right. So looking at the top line, consolidated net sales were down just slightly, 1%, to $19.857 billion. Let's call it just under $20 billion.
Okay, nearly $20 billion. And organic net sales.
Also down 1%. So pretty flat overall on the sales side.
And profit. operating profit.
That essentially matched the previous year, fiscal 2023, at $3.432 billion. So again, looks flat.
But wait, there's usually an adjusted number in these reports, right? How does that look?
Ah, good point, yes.
Hmm.
And that's where the story gets more interesting. Their adjusted operating profit was actually up 4% on a constant currency basis, hitting $3.603 billion.
Okay, up 4% adjusted. Can you quickly remind us what adjusted and constant currency mean here?
Sure. Adjusted basically means they pulled out certain items that might skew the picture, things like restructuring costs or maybe big impairment charges, one-off things. It aims to show the underlying operational performance.
Got it. More like the core business health.
Exactly. And constant currency just means they've calculated the numbers as if exchange rates hadn't changed from the previous year. So you can compare apples to apples without currency fluctuations muddying the waters.
Okay, so adjusted profit up 4%. What about earnings per share, the EPS?
Similar story. Diluted EPS matched fiscal 2023 at $4.31. But the adjusted diluted EPS was up 6% on a constant currency basis to $4.52.
So underlying profitability actually improved despite flat-ish reported sales. That sounds pretty resilient.
Very resilient, especially considering the environment. And they generated a lot of cash. Net cash from operations was over $3.3 billion.
$3.3 billion in cash flow. Wow. What do they do with all that cash?
Well, they put a chunk back into the business, $774 million in capital investments. But they also returned a lot to shareholders.
How much?
$1.363 billion in dividends paid out, which works out to $2.36 per share for the year. And nearly $2 billion, $1,977 million used for net share repurchases.
Okay, so significant returns to shareholders through dividends and buybacks. What does that split tell you? Investing some, but returning a lot.
It suggests a mature, profitable company. They're still investing, especially you saw that European pet food buy.
Right, $426 million for that.
But the heavy emphasis on dividends and buybacks signals confidence in their cash flow and a commitment to shareholder value. It's less about massive expansion, maybe more about optimizing what they have and delivering steady returns.
But it wasn't all easy, you said. The report mentions challenges.
Definitely. They called out a more challenging category and competitive backdrop.
Yeah.
And importantly, they saw greater than expected value-seeking behaviors by consumers.
Meaning people were trading down, maybe buying store brands more, looking for deals.
Exactly. That moment in the aisle where you compare prices, that was happening more intensely than they anticipated, it seems. That likely hit their volumes.
And inflation was still a factor, right?
It was. Input cost inflation was 4% in fiscal 2024. Now, that's way down from the 13% they faced the year before.
Okay, 13 down to 4% is a big improvement.
Huge improvement. But still, 4% on billions in costs adds up.
So how did they fight that? How do you offset rising costs like that?
Their big weapon here is something they call holistic margin management, or HMM. It's basically their internal program for finding cost savings and efficiencies everywhere in the business. They tout it as industry-leading.
HMM cost savings.
Okay, they used those savings to help offset the inflation. Plus, they kept investing in things like digital capabilities, technology, and, of course, brand building. Can't cut back too much there.
And they were tweaking the portfolio, too, buying and selling bits.
Yeah, we mentioned the European pet food acquisition. They also bought TNT Crust, a frozen pizza crust maker, back in fiscal 23. But they also sold off some brands that help remain meals. And suddenly, salad side dishes business went in fiscal 23 for about $607 million.
So buying in pet food and pizza crust, selling off some older meal brands, sounds like focusing on growth areas and maybe shedding slower ones.
That seems to be the strategy, sharpening the portfolio focus.
Okay, we've got the numbers, the strategy, but you mentioned that competitive backdrop. Let's talk about that. What's it really like competing in the food space today?
Oh, it's intense, brutally competitive. They're not just up against other big food manufacturers, the Kraft Heinz's or Kellogg's of the world.
Who else?
Retailers' own brands. Private label, those are huge competitors now, often with lower price points.
Right, the store brands keep getting better and more popular.
Exactly. So the report lists the key battlegrounds. You need constant product innovation, top quality, the right price point, strong brand recognition people need to trust your name.
Plus marketing, promotions.
Effective marketing, smart promotions, yeah. And increasingly, convenience in ordering and delivery. It's a fight on all fronts, really, for space in the pantry and the shopping cart.
Makes sense. And to make all those products, you need raw materials. What goes into the General Mills machine?
A bit of everything, as you'd expect. Grains are huge: wheat, oats, corn, dairy, meat, oils, sugar, vegetables, fruits, nuts.
The whole food pyramid, basically.
Pretty much. And don't forget packaging materials and energy. Those are big costs, too.
And getting those materials must be tricky sometimes. The report mentions volatility.
Extremely volatile. Think about it. Weather affects crops. Climate change has longer-term impacts. There can be scarcity. Commodity markets swing wildly. Currencies fluctuate. Trade tariffs pop up. Pandemics, wars.
Wow, okay. A lot of potential disruptions.
Yeah, the global supply chain is complex and vulnerable.
So how do they manage that risk? They can't control the weather or geopolitics?
They use a few strategies. They make advanced purchases of key ingredients to lock in supply and hopefully price. And they use financial instruments derivatives to hedge against price swings for certain commodities. It's about managing the risk you can manage.
Okay, risk management is key. And speaking of valuable things, they're brands.
Yep.
The names themselves must be incredibly important assets.
Absolutely critical. Think Cheerios, Haagen-Dazs, Pillsbury, Nature Valley, Blue Buffalo. These aren't just names, they're trademarks worth billions.
And they protect those names.
Vigorously. They register them in the U.S. and globally. They also do strategic licensing deals like using the Yoplait name for yogurt or making Reese's Puffs cereal under license. It extends the brand power.
And beyond the names, the actual recipes and stuff, patents.
Yeah, they focus on developing proprietary products, unique formulations, recipes, technologies, and they protect those innovations with patents where they can. It's all part of defending their competitive edge.
Okay, so we've covered the business side, the competition, the supply chain. What about the governance? How a company this size operates responsibly? Regulations must be a huge factor.
Oh, massively. Food and pet food are understandably highly regulated industries.
Yeah.
In the U.S., they answer to the FDA, the USDA, the EPA, plus state and local agencies.
Covering what? Production? Labeling?
Production, packaging, labeling, marketing, quality, safety, you name it. It's
Right.
extensive. The report does mention a couple of environmental cleanup situations, response actions, related to hazardous substances in Minneapolis and New Jersey.
Anything serious?
They state pretty clearly these are not reasonably likely to have a material adverse effect on the company. So, seems manageable.
Good to know. And running all this takes people. A lot of people, I imagine.
About 34,000 employees globally as of May 2024.
34,000. How do they approach managing that workforce? Human capital, as the report calls it.
They emphasize recruiting, developing, engaging, and protecting employees. Makes sense, right? Your people are your foundation. So they talk about training, career development, running employee engagement surveys to keep people committed.
And diversity and inclusion, that's a big focus for companies now.
It is. They state they're actively working on a culture of inclusion and belonging. They provide some numbers, too. Women make up about 49% of their officer and director group.
Almost half. That's pretty good representation at the top.
And about 24% of officers and directors are racially or ethnically diverse. The stated goal is to have a workforce that reflects their consumer base, which they believe helps the business.
Makes sense. One more area before we look ahead. Cybersecurity. For a company handling so much data, so many operations, that must be a constant worry.
Absolutely critical and a huge ongoing effort. They use a standard framework NIST to guide their cybersecurity program.
NIST, National Institute of Standards and Technology.
That's the one. They do things like hire outside experts for adversarial testing, basically, ethical hacking to find weaknesses. They run phishing simulations for employees, constantly communicate about threats.
Have they had any major breaches?
The report says they face continuous threats, which isn't surprising, but they haven't experienced a material cybersecurity breach, and their audit committee keeps a close eye on it. So constant vigilance is the name of the game.
Okay, so that's a look under the hood. Let's pivot to the future. What does this all mean for the road ahead? What are the big risks they're watching, and what's their outlook for fiscal 2025?
Well, the risks they outline in the report really echo a lot of what we've talked about. Intense competition is number one. Just holding on to market share is tough.
Against both big brands and private label.
Exactly. Then there's the challenge of keeping up with consumers. Tastes change, eating habits evolve, people shop differently now, more online. Plus, concerns about ingredients, sodium, sugar, GMOs, specific things in pet food. It's always shifting.
And you mentioned brand perception earlier. How quickly things can change with social media.
That's a specific risk they call out. Information or misinformation spreads incredibly fast online now. A brand's reputation can take a hit almost instantly if something goes wrong or gets misinterpreted.
Yeah, that's a scary one for marketers. What else?
Supply chain disruptions remain a big worry. We listed some causes earlier: weather, climate change, pandemics, war, labor shortages, anything that breaks that complex chain.
Okay, so operational risks. What about financial ones?
Financial market volatility is a key one. Commodity prices swinging, interest rates changing, these have direct impacts. And they carry a substantial amount of indebtedness, about $13.2 billion. Managing that debt is crucial.
13.2 billion in debt. Okay.
There's also the risk of asset impairment. We saw some non-cash charges for that in 2024 related to goodwill in Latin America and some brand values like Top Chews and Epic.
Meaning the value they carried on the books was deemed too high.
Essentially, yeah. And they noted they're keeping an eye on other brands like Progresso, Nudges, Uncle Toby's, and True Chews because the value might be getting close to the carrying amount, risk of decreasing coverage, they call it.
So potential future write-downs there.
It's a possibility they have to monitor. And finally, pension costs can be unpredictable depending on interest rates and how pension investments perform.
Wow. Okay. Lots of risks to navigate. So what's their game plan? They must have a strategy to tackle all this.
They do. They call it their accelerate strategy. It's their blueprint for growth and shareholder returns.
Accelerate. What are the main pillars?
Four things. Boldly building brands, relentlessly innovating, unleashing scale, meaning leveraging their size for efficiency, and standing for good, which covers their social and environmental efforts.
So focusing on brands, innovation, efficiency, and responsibility.
That's the core idea. It guides how they prioritize markets, which brands get the most investment, and how they reshape the portfolio through those acquisitions and divestitures we talked about. It's about staying agile despite their size.
Okay, so based on that strategy and all the risks, what are they actually forecasting for fiscal 2025? What are the targets?
They're projecting a relatively stable year, maybe slightly cautious. Organic net sales are expected to be somewhere between flat and up 1%.
Flat to plus 1% sales growth.
Okay.
Adjusted operating profit is forecast between down 2% and flat, again, on that constant currency basis.
So profit could dip slightly or stay flat.
And adjusted diluted EPS is expected in a tight range, between down 1% and up 1%, constant currency. They also expect strong cash flow, aiming for free cash flow conversion of at least 95% of their adjusted after-tax earnings.
So overall, a forecast for stability, maybe treading water a bit in a tough environment, but maintaining strong cash generation.
That seems to be the picture, and they did note they plan to increase investment in brand building.
Even with flattish profit forecasts?
Yeah, which is interesting. And they expect their HMM cost savings, remember those, to come in at 4 to 5% of cost of goods sold.
And they expect that to exceed their forecast for input cost inflation, which they see at 3 to 4% for fiscal 2025.
So they're betting those efficiency savings will more than cover expected inflation, allowing them room to invest in brands even if profits are flat overall.
Exactly. That's a key part of their plan to manage profitability. They're relying on finding those internal savings.
This whole deep dive, just looking at the 10K, really shows the incredible balancing act these huge companies perform, doesn't it?
It really does. Innovation versus efficiency, global markets versus local tastes, managing costs versus investing in brands, dealing with all those external risks. It's complex.
So maybe a final thought for you listening. Knowing a bit more about what goes into a company's annual report, how might your view of the brands you pick up every day change? What new questions might you ask about the giants behind the food on your table?